Good afternoon, ladies and gentlemen. A very warm welcome to you on our special show, Market Masters, where you get to meet the finest brains on Dalal Street, individuals and professionals who have navigated bull and bear markets with equal ease over the last 3-4 decades. And the finest among them is with us today. It's a great pleasure in welcoming Mr. A. Balasubramanian, Managing Director and CEO at Aditya Birla Sun Life Mutual Fund. Bala sir, as we all know, started his life as a bond trader way back in 1992, and he's the best person to ask how these global yields in bond prices and the problems that we face globally are going to impact Indian markets. A very good afternoon to you, Bala sir, and a very warm welcome. As they often say on Wall Street, that gentlemen prefer bonds, and you are the best guy to ask what is happening in this global bond market. How do you see these rising yields of 30-year paper in the US, UK, many European markets, as also in Japan, in India too? How do you think they are going to impact sentiment?
Yeah. Thanks, Shalendra, for the nice introduction. Of course, I happened to be the bond market and overall capital market for the last 35 years. As you rightly said, bond market used to be close to my heart the early part of my career. Then I got converted into a hybrid, including equity as time progressed. So now, having spent a good number of years, I think the way I see is the bond market is always the lead indicator for many things, especially the fiscal position generally gets reflected on the bond market. The health of the companies, health of the state is reflected in the bond market. And macro variables, which has got huge linkages to the bond market, especially the inflation, is something that has got directly linked to the bond market, as well as the way government runs the financing. So going by that, if we see, I think Japan, when you mentioned about Japan, you mentioned about US. US, of course, the bond yields have been quite high the last few years on various consideration, including high fiscal and high inflation has been hitting them, and also the growth rate in US has been pretty very strong. In the case of Japan, they were the only country I used to normally say that the only country in the global market used to pray that they should have inflation. They should pray to the God that inflation should be back in Japan. In fact, the inflation which has come back has also put up the yield because they were at the lower yield for a very too long period of time, and too low yield also is not highly productive from the economic growth point of view. Therefore, even Japan yield shot up thanks to the inflation coming back in Japan. But having said that, I think India has been one market where we have been extremely successful in doing the right balance between attaining the greater success on fiscal balance, current account balance, deficit balance, and third, of course, the inflation. I think all the three parameters which generally is being taken into monetary policy authorities for taking decision on rate cut or rate increase. I think India has been extremely successful in completely eradicating the twin deficit, which used to be there, current account fiscal deficit. We are now completely eradicated. We are on the right path to attain greater success on this space. And inflation is the one which I think Government of India has been primarily focusing on inflation for the last 10 years by taking various proactive measures by the government on one side. Second, from the RBI point of view, keeping the interest rate low, or has been helping the inflation a lot more under control in India. But having said that, whereas the reverse happened in the US and other global markets, because the fiscal was out of order, that the inflations are high, job markets were pretty strong in the US. But having said that, the current scheme of thinking with Trump has been saying that the US rates cut has to come very soon. My own belief is that this year, probably the rest of the year, US Fed, I think, looking at cutting rates by anywhere between 50 basis points and 1%, which essentially means the bond market can rally.
Right. Bala sir, before we get into the equity side of the market, would you want to comment on inflation at an 8-year low, GDP for the quarter gone by rising dramatically, much ahead of expectations, and in all this good macro, as you yourself point out, the problems that we face because of US tariffs. Do you think there is space enough fiscally for India to overcome this issue?
I think I keep saying this India in a sweet spot in managing the current uncertainty. Thanks to the fiscal improvement which you have now done, and I think government of India has done a significant achievement on attaining the fiscal right balance, which essentially means we have enough room for us to spend money if need be. I think, as you rightly put, the GST discussion is also to drive the economy to the next level of growth by cutting the GST rate so that the consumption can pick up. Unless we have a room available for spending money through a GST cut, it will not happen actually. Therefore, the government finance improvement that has happened in the last few years definitely is coming in handy. The recent growth momentum of 7.8% is a reflection of how government recognized the last year due to the multiple elections, the spending got postponed, and government realized that. And I think the finance minister has been ensuring that each of the ministries where the capital allocation is kept, they have to be utilized for the purpose for which this allocation has been kept to drive the public sector spending. That something is going has got revived. That's why we saw the number of 7.8%. On top of it, I think the Make in India theme, which is basically the producing goods for India, very fact that yesterday the Prime Minister announced the sample chips of semiconductor chips, which again it's only one of the fast growing industry, and therefore the money is being invested by private sector in building new capacity on certain areas like electronic manufacturing, chip manufacturing, and also the renewable energy panel manufacturing. I think India progressed quite a lot. Also, I think it was coming handy for the private sector to contribute to the overall GDP growth numbers. So, in my view, it's a quite happy news. Except the GST reduction have been announced before the festival season. Therefore, I would assume there is a bit of postponement of consumption to some extent that we can expect. But as the festival season begins, combined with the GST cut, with the price reductions coming in, it can actually be a win-win situation for both the companies who are producing goods as well as the people who are buying the goods at lower rates.
Okay. Bala sir, let's come out, let's discuss the most important event for today as also for the rest of the calendar year, financial year, which is the GST rejig. One, what do you think are likely outcomes of the GST meet today? Sectors you think which will benefit, and sectors you think which will sort of, be on the wrong side of the GST panel?
Yeah. So I doubt, I think any industry will be wrong side of the panel, given the fact the GST rates have always been somewhat high in certain segment, which is basically the sin sector, what you talk about, is always remain high. And despite last number of years, increase in tax have not reduced the consumptions. Therefore, it will not be a lose-lose kind of proposition. Even if it is not win-win kind of proposition, it will be neutral. But having said that, I think take the slabs completely from 5, 12, 18 and 28 and bringing it down to two rate slabs, and with the introduction of the sin tax, which is basically the 40%. In my view, I think the good number of segment of the market covering all sectors, right from the one which actually benefits the large pool of consumers in the country. I think most of the sectors will get the benefit. And the large benefit, my own belief is, will come into the FMCG sectors. I think rightly the finance minister has mentioned in the budget that this year focusing on consumption is very important. And next year, as we go along, your 8th pay commissions will get reset in the year 2026. Therefore, these announcements coming in before the 20th 8th pay commission getting reset, which will give more money in the hands of people. And this year, monsoon has been very good. Therefore, agriculture income is also quite robust. And now the Reserve Bank of India has been pushing for higher credit growth in the system, which has got slowed down the last 1 year. I think all these things, if we put together, I think 25, 26, rest of the financial year, and 26, 27 could be a great year from boosting the consumption, which essentially means across sectors will get the benefit. I don't think any single sectors will get missed out. But high-end, of course, wherever the high affordability is there, high-end sectors, which is goods that is being sold, say more than 50 lakh rupees per items or say 1 crore kind of items, they may probably to some extent get hit or maybe not get hit. But to the extent the price reductions may not really encourage the buyers to come forward and spend that money. But that, in my view, will not be a losing proposition for the government. Given the fact that large pool of consuming items from public at large point of view, if they get slabs come from lower slabs, and therefore consumption picks up, will actually lead to the increase in tax collections in widening the base, I would say.
Right. Bala sir, now let's move our discussion on the equity side. So you mentioned a sweet spot for the Indian balance sheet as far as macro is concerned. Add to that good monsoons, add to that the income tax cut, as also lower interest rates, and now the GST rejig. How are you thinking in terms of deploying fresh money that is coming into Aditya Birla AMC from SIPs? Where is that fresh money going given this background around us?
Yeah, definitely, because one staying with a lot of conviction on staying invested on equity. We don't generally take a cash call, which essentially means that we stay invested most of the time in equity. And also given the fact that we as a fund house, of course, take sectoral calls at all point of time in terms of where do you want to go overweight. Basically, these assumptions definitely as a fund house gone overweight on FMCG sectors in the last few months and increase exposure to that segment. We also increase exposure to some of the sub-segment related to the public sector spending, which is the construction activities, mainly on cement. And at the same time, we've also been extremely bullish on financial sectors, given the fact that the lending growth will start picking up and cost of the borrowing comes down, then naturally lead to a significant pickup in the lending growth. Therefore, that's also sectors we continue to remain overweight. Clearly, the portfolio constructions, it's not built on the base of what is coming in only now. It is built on the base of where India will grow for over a period of next 4 or 5 years, keeping in mind the larger focus of taking the Indian economy to into economy, which essentially means that we take a 3 to 5 year kind of call on basis which, except the small taking which I mentioned about, go over and underweight, but otherwise stay convinced on most of the sectors in India, except a few sectors which are more cyclical nature, which will also get impacted because of tariff, which is gems and jewelries and textiles. These are some of the sectors may get impacted because of tariff issues. But otherwise, most of the other sectors are predominantly domestic driven and the India centric kind of business. That's why we remain overweight.
Okay, so which is, domestic plays, rate cut beneficiaries, as also, maybe GST beneficiaries in the form of cement. These are the core areas where fresh money is going in. Bala sir, there was this earlier NFO that ABSL had launched, which was on the defense space. Now, how do you see this sector? It's gone through volatile times. We've had Operation Sindoor. We've also had the government backing local PSUs and local defense production. In your mind, what are the 2 or 3 niches within the defense space that should do well in the medium term?
I think the defense space is something, is a new industry which got the renewed focus in the last 5-6 years. Of course, some of the Indian public sector companies have always built a huge capability in the space of defense manufacturing capability, and they have been producing for indigenous purpose. But having said that, the last few years, one increase in allocations, and post the Operation Sindoor, I think people also realized the capability of India that got built in the last 4 or 5 years, which need not be necessarily be used only for the purpose of serving Indian needs. It can also provide a greater need for servicing other countries as well. Therefore, it opened up few new business opportunities for companies. At the same time, given the fact that worldwide post this Trump tariff thing, every country in the world has started looking at inward as to what they should do in terms of increasing their defense expenditure as part of the budget. That is being the rise in budget allocation that we are looking at it. Therefore, this sector would definitely get the needed importance. But having said that, one should not get caught in the valuation of these sectors because these sectors are not driven by only the profit. It's also driven by the order book, and these order books are generally not disclosed to many because they're all secret orders coming from the government, respective government. Therefore, one has to assess it on the basis of the potential of the product segment in which they are there. Therefore, the sector is good from a medium to longer term point of view, but one should also be a little bit careful in terms of how the stocks can be selected. Therefore, we as a fund house have got the defense index fund. The best way to play the sector is not by the stock specific, it going by the sector specific by of an index. Having said that, we also of course launched a fund in the last year, a conglomerate fund we launched. In fact, to invest in companies or promoters who are building the nation. There are many promoters who are building the nations coming from different sectors and industries representations. That's something also we did around the same time. That's all I just highlighted because we just not only of course made defense fund last year, done very well, but I always believe that I think defense index fund would be a better way to participate. But individual money managers, we also of course exposure to the active funds, exposure to defense stocks, purely on the basis of individual bottom-up stock strategy. That's something will remain more selectively in our existing overall portfolio construct that we have.
Okay, fair point. Bala sir, we have this situation with the US economy where now they are insisting on tariffs to be about 200 to 150% on Indian pharma exports as well. Do you think that will happen? One. If yes, does that sort of vitiate the investment thesis of the Indian pharma exporters? We send in about $10 billion worth of Indian pharma exports to the US each year. Are they at risk?
So I think we are more at the risk because the noise levels are being high. But in reality, the sector which has done a great service to the nation and especially the international communities in bringing the cost of goods, the cost of drugs for the global consumers. I think India has played a very large role by being one of the major supplier of the supplier of raw materials to the global manufacturing companies. So therefore, the role that India has played in the global pharma industries cannot be ignored by putting very high taxes. I think I'm sure US also will realize that over a period of time, and this Indian service to the global economy cannot be ignored. And pharma being one of the integral sectors where health is most important for everyone, India has played a very large role in this space. Therefore, current noise of the 200%, 250% kind of noise levels, in my view, it's more of a temporary, or probably I would say it is more to negotiate a deal which could be better than what they would have originally thought about. So it's better than something to zero if you don't make it. Definitely you have to start high and ultimately negotiate. And also given the fact that while on the tariff side, a lot of issues, a lot of discussion being around, my own feeling is neither the US can ignore India and nor India can ignore US, given the fact that we have a very strong relationship in multiple sectors, right from service to the manufacturing sectors. And the mutual benefit that I think both can derive over a period of time cannot be ignored. Therefore, the current discussion about tariff may also find its smooth landing very soon than I think what generally people expect. I'm sure both the side will start realizing it very soon, and therefore they will find the right middle path which can actually not do too much harm to India, at the same time not do too much harm to the rather get some kind of benefit compared to the earlier one from US as well. Therefore, it can be made to win-win, which I am sure the policymakers and authorities would be keeping this in the back of their mind, and solution could come very soon on this space there.
Okay, sir. Bala sir, on balance, when you sort of look at the positives of the Indian market on one side, the negatives that are upon us, and the valuation matrix, what is your gut feel? Where are we headed?
So I think we would see the valuations, in my view, has gone through last 1.5 years of time correction. I think this valuation is not discovered today. I think we have been talking about valuation issue for the last 1.5 to 2 years. And the markets have remained somewhat flat. If you look at Nifty return for the last 1 year is either flat or marginal negative. And that's why you will find that most of the indices have gone through that period of correction. Therefore, if I continue to maintain the valuation, it would be an issue. I think I may be proved wrong, and given the fact market has gone through time correction. Second is, having seen the growth slow down, the effort that is being taken by the 7.8% came as a surprise. Whether you believe it or not, the number is true, and that's something which came as a surprise. Assuming we are able to sustain it for the next 2-3 quarters, and the steps that is being taken, as I mentioned earlier, like GST, interest rate reductions, the lending growth coming back, and I think renewed relationship discussions with some of the Asian countries by our Prime Minister of India, all these things will lead to a better growth outlook as we move forward. Therefore, the market, moment starts seeing some element of improvement on the credit growth numbers, you will start even festival season when they start reflecting on the some of the consumer durable numbers. You will suddenly start actually the market recognizing this fact and start assuming the trend. Market will start looking at 27 earnings rather than 26 earnings. My own belief is 27 earnings will be better than 26 earnings, and therefore one should not take the call. Valuation is costly, therefore one should avoid. I think it's the time to keep building the portfolio to reap the benefit in the next 3-year time frame. Also, you must remember, next 1 year discussion will start coming around the stepping up the focus by the government of India in terms of infrastructure building, as well as private capex will pick up. I think the real reflection will start coming in 27-28. Therefore, that can't be ignored, and even foreign investors, as the rate cut has happening, I think foreign investors will start looking at emerging market, and India, my own belief is, will become one of the most sought out economy where the money will start coming in, given the fact last 2 years they have removed money. Therefore, the incremental money as the rate cuts start coming in, I'll also be not surprised if the FI flows increase than even the domestic flows.
Right. Bala sir, $5.4 billion of net FII sales in August, $5.2 billion in July, fourth year running net sales by our foreign funds. I am sure you have made them very angry. What is the reason behind their sales?
No, I think the way I look at it, the way I would look at it, I think among the emerging market location, we must also look at where they have made the maximum money. And India is the only area where the last 4 years, foreign investors made the maximum money. If you go by the exit that they have done in various companies, right from Hyundai to various companies in which they made private capital investment that they made, they could tap the public market and take the money, including Paytm. I remember Warren Buffett was the first one to get out at the price of 1,000 Now the price is back about 1,000 rupees. I'm just taking the example of Paytm, not with the intention of talking about the stock, but the intention of saying how smart investors encashed their profit opportunity in India, therefore they moved out. Therefore, they all gone back to their own destinations with deep in the money. Therefore, for them to come back and take risk on India will not take much time. These guys are very smart, they take risk at the appropriate time, very high risk they take. Therefore, the risk capital, the moment risk on starts coming in, I would not be surprised if the overseas flows comes with a similar vigor. But the money they had moved out, I would say that India is one market where they made a big amount of money. For a variety of reasons, they moved out because the US bond market yields are pretty high, and therefore they all went back to various destinations. In fact, that would have worked for them sometimes, including China money coming back. But I must mention that all of them have gone out of the country with the deep in their appreciations in the money. Therefore, they would also equally come back with similar force.
Yes, I think a lot of the people in market are waiting for a slight reversal in these FII net outflows. We haven't seen this kind of selling ever. And what is really good is, when you point about this sweet spot in the market, $10 billion has been absorbed without even batting an eyelid in the last 44, 45 trading sessions. We've absorbed the problems with Operation Sindoor, we've absorbed the US tariffs, and we've also absorbed these rising bond yields. If all of the, tell me.
Say once that I think I haven't seen market cycles for 32 years. I think the period where we used to get jittery when this thing happens, when the FI selling happens, currency behaves differently. The global market, if something happens, our economy, we used to always get jittery in the market. But now I think completely reversed because the domestic power of savings having now come to the mutual fund, and that's also coming to the capital market. I think we have seen one of the best resilience period in the last 7-8 years. the tolerance actually risk is also has gone up quite significantly, which in my view, it's a very strong reflection of how the economy is progressing.
Okay. Bala sir, we also heard about this taunt coming in from the US president that among 2 or 3 countries, the dead economy of India was also among them. As a fund manager, as a deployer of thousands of crores in equities as also bond and debt, how do you react to this statement?
I am not very sure. But one thing is getting repeated again and again. Maybe whether it was a slip of the tongue, we do not know. Maybe we must give the benefit of doubt to them. Instead of calling the dead economy, dead of the economy, you probably use the word of dead economy. We do not know. Therefore, I don't think we should take that seriously. Because anybody who has seen Indian market, anybody who has been calling India as their friend, and he has always been maintaining that our Prime Minister is one of his friend. Therefore, calling this a dead economy, I think probably should be, we do not know how far it can be taken seriously. But having said that, I think we must take pride that among all the economies in the world, US fiscal deficit is the highest, and today there's the pressure of currency, whether they will remain as the core currency in the world, or everybody is splitting, and India is the only currency, even we talked about, can become the core currency in the world market, and India is the only country got upgraded in the last number of years. We have been pitching for upgrade of India for the last 5-7 years. We have been making a pitch saying why S&P is not looking at upgrading India. In fact, this time upgrade of India came by one notch, which is coming at a time where somebody is thinking differently about our economy, which again is reinforcement of confidence for the rating agencies that India has been taking steps that will lead to a stability on fiscal, more stable currency, and domestic growth will become real, and inflation will be a lot under control, and monetary policy will always be supportive, and reforms will continue to be a major agenda. Even today, Prime Minister talking about next round of reforms, which essentially means the hunger to the economy to the next $100 trillion economy continues to remain very high. Policymakers today are extremely working overtime to ensure the India growth story continues to remain very, very strong. Therefore, this has to be ignored in my view.
Right. Bala sir, one final question. That one sector, one stock or one index that you would want to invest for the next 6 months?
Yeah, of course, my belief is FMCG sectors would probably be the driver, including autos and FMCG sectors. In addition to banking and financial sectors from a broader market point of view. From an index point of view, I'm bullish on next Nifty 100, which is basically covering large and mid-cap companies. Because as the market sentiment improves, a wider index will be the larger driver of the market. Not Nifty or Sensex, the next Nifty 100, which is the one I would probably say.
Right. On this very bullish note, we'll call it a day for this interview, ladies and gentlemen. One very important thing about consistency, if you want to learn in life, you can do so from Bala sir. One job, 1992 till 2025, in the same organization and in the same sector and at the same space. Thank you so much, Bala sir. What a pleasure speaking to you.
Yeah, my pleasure. Thanks.
That, ladies and gentlemen, was Mr. A. Balasubramanian, MD and CEO at Aditya Birla Sun Life Mutual Fund. He's bullish on sectors such as cement, sectors such as NBFCs, and of course a whole host of GST beneficiaries, to some extent depending upon where valuations are, even on the defense space. And two themes run strongly in his thought process. One, of course, is the next Nifty 100 index. Please keep an eye out on this one. I think that Aditya Birla Sun Life Mutual Fund has an ETF based on this fund, this index, and of course a whole host of positives on the larger macro side. Thank you so much for watching. I hope you enjoyed the conversation as much as I did.